That I actually want to introduce Joe and our special guest Matt Balderston because we're going to be talking about crash testing your retirement plan.
Yeah, a great point. When you take a look at retirement, you got to, or when you're driving a car, you want to make sure that it's crash tested. Yes. See, with your retirement, there's a lot of risks that people face, Matty. And so let's talk about just a few that people need to be aware of when they're approaching retirement. What are some of the biggest risks that they have?
Taxes is one of the biggest ones. You know, how much are you going to be paying in tax when you withdraw money from your various accounts, or even if you have pensions or Social Security? There are tax ramifications of each one, and setting up, you know, where your assets are located can help keep an enormous amount in your pocket if you set it up right.
You would think that when people approach retirement, they think taxes is probably on the back burner, that they think that they're going to pay very little tax because that's what they've heard for years and years and years, is that you'll be in a lower tax bracket in retirement. But what have you found? If people that have saved a little bit of money, we find maybe the exact opposite.
Yeah, a vast majority of people have, you know, are in the same tax bracket they were when they were working. And, you know, 401k companies, and they'll promote that you want to, you know, save in your 401k plan or 403b or other plan at work because you'll be in a lower tax bracket in retirement. But that's not always the case. A lot of our clients that have the most flexibility and pay the least tax are people that have actually saved some more money in tax-free environments or even the taxable retirements, an account, you know, in the name, a joint account with their spouse or in the name of their trust that's outside of retirement plans. That gives you a lot of flexibility because of the capital gains environment, which is lower than regular income tax.
Yeah, you know, if you look at tax diversification and then having money in different pools of tax-free capital gains, tax-deferred, you know, then you really have something. Then you can basically look at, all right, well, where am I going to be pulling my dollars from to make sure that I can control my taxes in retirement? It's key. Another big risk is that there's something called like sequence of return risk, or when people, you can look at the studies. If someone retired in 2008, versus someone retiring in 2010, let's say, they're going to have a totally different experience, even though they might have the same dollar figure.
Exactly. Yeah. No, if you get a lot of losses in the first couple of years of retirement, the problem with that is that you're selling shares that are, you know, never going to come back. You know, you're selling them low, and those aren't ever going to get a chance to rebound. So what you want to do is set up ahead of time a cash flow strategy for yourself where you know what the rate of return is that you need to maintain that cash flow, and then take the least risk possible to maintain that cash flow.
You know, when you look at the chart here, is that when you have lower returns and you're pulling dollars from that. So if I retire right there in the beginning of that graph, right, the markets are down, even though I have an average annual rate of return of 10%, but you have to take a look at each of those different returns. It makes no difference what the average rate of return is. It makes a difference when those sequence of returns hit your account. Because the math works like this. If I have $100,000 and I lose 30% of my money, so that's 30,000, right? 100,000, I lose 30%, that's 30,000. But the next year I gained 30%. People think, hey, I'm good. But 30% on that dollar figure is only 21,000, and if I'm taking money from the account, that's where we see people run really into problems.
Exactly. And so a way to help protect against that is to make sure you at least have 7 to 10 years of your investment portfolio or of your cash flow in the safest of investments, whether those be bonds or even a portion in cash. That allows those stock holdings, which are the ones that are likely to drop the most, time to rebound, and then you don't have to sell them when they're down.
So we're looking at taxes, all right. So one of the biggest expense people have is taxes. So if they can manage their taxes in a certain way, then they can take less risk. That boils right into the sequence of return risk, right? Because if I'm taking less risk in my portfolio, those big swings in the overall market is not necessarily going to affect me. And one of the, I guess, a double-edged sword here is the last one is longevity, right? We're living a lot longer, which is a really good thing, but it's also bringing some anxiety because people don't necessarily want to run out of money.
Yeah, and if you aren't taking enough risk to try to get some growth, then you could actually run out earlier than you expect. So one of the things we do is we always try to run out our projections out to at least age 95 that's well beyond the standard life expectancy now, and life expectancy has been going up lately. I mean, that's actually a big issue right now. Is within the last 15 years, the average life expectancy of men and women who've hit age 65 has gone up by 2 years, just in the last 15. The average man now lives to about 87 and woman to about 89. So that's a long time to plan for.
You know, you look at right here on the screen, what, 86.6 years? 88.8. And where do you think that's going to be once people reach that age? You know what I mean? So if I'm 65, right, I'm planning for retirement. Well, now I reach that 88 life expectancy. Wait a minute. Now my life expectancy is 108.
Yeah. If it's going up 2 years every 15, you know, we're all going to be living to 152. You know?
That should be a good time. Oh, that's Matt Balderston, folks, a senior investment advisor, certified financial planner with Pure Financial Advisors. Matt, where can people get more information about you and the things that you do?
The best place to go is our website, www.purefinancial.com. You can also request a free assessment there, which I know that we promote here because it's especially along with the crash testing of your retirement plan goes right along with those assessments.